Hey, it's Mike Hambright with FlipNerd.com, and welcome back for another exciting VIP interview where I interview successful real estate investing experts and entrepreneurs in our industry to help you learn and grow. Today, I'm joined by Dan Miller. He's the co-founder and president of Fundrise, a crowdsourcing platform that has a unique and kind of interesting approach to the market and what they focus on. Dan is going to also give us an update and overview of recent regulatory and technology changes in the crowdfunding space because, as all of you listening to this know, it's a constantly evolving field and there's some interesting changes that have happened recently. And then we're going to talk about urban infill projects, usually in densely populated areas, which is really what Dan focuses on. We haven't really had anybody talk about that before on the show, and it's going to be really interesting. Before we get started, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days. Rates start as low as 9%. We'd also like to thank National Real Estate Insurance Group, the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Dan, welcome to the show.
Thanks for having me.
Yeah, I'm excited to. We've had a few crowdsourcing people on before, as I mentioned to you, but it's been a little while, and I know there have been quite a few changes, so it'll be great to get an update. Before we get started, though, why don't you tell us more about you and even a little bit about what you're doing now?
Sure. So my brother and I started Fundrise in 2010, but it actually came out of our real estate development background. So our father was a large developer based out of DC, built around 20 million square feet, mostly urban infill mixed-use projects. We grew up around that kind of neighborhood revitalization, urban development deals. My brother and I spun off, started doing our own transactions, and that's when we realized there were a lot of gaps in the capital market. So in particular, we were focused on urban infill deals in some of the emerging areas of Washington, D.C., H Street Northeast, Shaw, neighborhoods like that, and found that for deals where the check size, the equity check was below 10 million, institutions couldn't make the investment. And there was really a gap in the market, so we built Fundrise to allow individuals to invest with us in these transactions. So what started out as a platform to raise capital for our own deals, it's the first crowdfunding platform in the country for real estate, now has become a platform to raise capital for other real estate companies.
Yeah, it's fascinating. I think there are a lot of people that live in neighborhoods, especially in kind of inner cities, where there are rundown sections or buildings that just seem to sit there for decades and never go anywhere. And they're really probably, correct me if I'm wrong here, they're generally a little bit too big for the average individual, and they're probably way too small for the average institution, so they just kind of get stuck there, right?
Yeah, that's really the market we focus on, because you look at a lot of these neighborhoods, the residential sales happen very quickly. There's a lot of turnover, fix and flip, homes being upgraded, and then the commercial strip kind of sits there with old dilapidated buildings that you would think would be renovating, but the issue is they're a couple $1,000,000, so it's not something that an individual can buy easily and do themselves. But they're too small. A couple million is too small for institutions. So they're in this gap where you really have to raise friends and family capital. There aren't that many sources of funding. But those are really the projects that help revitalize those neighborhoods, help bring new demand and new businesses. So for us, we found that we were building those projects. And after we did our first few deals on Fundrise, we had people from around the country reaching out to us who were doing the same type of project in the old Fourth Ward in Atlanta or in East Nashville, or in downtown LA that had similar profile and similar theme. And that's when we kind of realized it wasn't just us with that frustration. In general, as a product, it's been very underfunded because it just fits in the middle in terms of size, as you mentioned.
Yeah, absolutely. Well, tell us more about you personally, your background. I know that you got into the business because it's been in the family for a long time, but maybe talk about kind of how you got to the point to where you started Fundrise.
Sure. So I finished business school in 2010, spun out, started working with my brother then. So we had always had a wonderful relationship, had wanted to work together. He's 11 years older than me, so we weren't beating each other up.
Yeah.
But I think it created a dynamic where he, helped guide me, and I learned a lot with him. And when we started working on our own, we thought, we're both interested in real estate. Let's find some properties and projects that make sense for us. And we both, in particular, have a real passion for urban development. We didn't want to just buy buildings. We wanted to create an environment, lease, and create tenants that we thought represented that area and fit the best. So we started buying in what were up-and-coming neighborhoods. That's how it's considered, but it was the places we were going out at night, that we were spending time, where we were living. And it was just obvious to us that there's an unmet demand for millennial, probably the 25 to 45-year-old age group. Most of DC historically had been developed for law firms. It had been developed for big corporate use, which is good for a certain segment of the market. But then when you talk about more creative, emerging areas, historic rehabs, there was very little of that product. So that's really how we started buying, renovating old historic buildings. The first project we bought and leased actually just opened this past week to huge success. As an example of the type of project we had done, it was a 5,500 square foot old auto garage. We bought it and not had a certificate of occupancy that was valid since the 50s.
Oh, wow.
So, probably hadn't had a dollar go into it since, the late 60s or even later. So we bought the building, rehabbed.
So talk about that. Who's owned that for 55 years or plus?
So this area, H Street Northeast, was actually in MLK riots, was mostly burned down. So it was really one of the core shopping streets in the city. When they installed the train tracks, it was on the other side of the tracks, slowly declined. And then in the late 60s, there were riots. Most of the buildings were burned down. So a lot of these buildings had basically damage from the past. A little bit of money had been put in them to have them used. This was a convenience store that was open, 2 or 3 hours a day. The owner lived upstairs. He wasn't selling much of anything. He just owned the building, and we bought it in 2010. And at this point, the price is probably up 3 or 4 times, just given what used to be a very edge neighborhood is now considered central.
Right.
And so we just went owner to owner on a lot of these properties. I mean, they were individual owners that had them for a few decades, that were living, above. Not traditional developers, not sophisticated institutional buyers. And I think that's also what made it interesting to us. You were working with the fabric of the neighborhood. You had to lease to local tenants because those are the people that understood the demand. National credit chains weren't yet comfortable in those types of neighborhoods. So we had to find the local sellers, work through the process with them, find local tenants. For this one, we actually financed a good chunk of the business to get them open in the space. It was one of the leading tenants in the neighborhood who now opened a second location. So it really took us, managing the acquisition, the financing, the leasing, the construction, the development, really all those components to have the outcome, which was really creative, interesting development deal.
Right. That's fascinating. I know there's a lot of people that are listening to this that are imagining scenarios of where they live or where they've lived in the past. And like I said, I used to live in the D.C. area, and so I can appreciate that. And my wife lived in Manhattan, so we can appreciate a lot of these things you're saying. So it seems like a big potential play is to continue to revitalize that existing area, because it's almost like a domino effect, right? You've got, once somebody starts to do something, as long as other people start to revitalize the area, then it kind of lifts the values for everybody. Talk about that just kind of general phenomenon.
Yeah, I think, and that's really been shown in the past 5 to 10 years in terms of pricing and focus. I mean, in 2005, 2006, the kind of trend of urbanization, going to areas of the city that were cheaper, restoring old buildings and revitalizing neighborhoods, it was apparent that it was happening, but on not such a grand scale, whereas now you have big institutional players like Starwood investing in Williamsburg in Brooklyn, which 5-10 years ago was not an institutional neighborhood. Right. So you started to see, a mass migration to urban centers in the U.S. and around the world, core pricing, become extremely prohibitively expensive. The downtown San Francisco, New York, DC, LA, it's really just not affordable for anybody who's earning a normal amount of money in that market.
Right.
And so then the requirement is, well, I either have to go way out, or I can find a lower priced urban area that's still connected to the city. And that's where you've seen the growth of downtown LA, the growth of Brooklyn, the Northeast Corridor in DC. In every market, there's that neighborhood, that area with the old abandoned section of town that people just started buying and opening up restaurants, opening up bars. not glamorous, not big chain development, kind of natural from that area. And I think it also shows the shifting dynamic towards more creative development that feels like it should be in that context, in that location, with an operator who knows that area, as opposed to the kind of mass commercialization that ruled from the 60s or 50s to the late 90s. So
right.
It's that broader shift, urban regeneration with more creative uses of space that I think started to bring a lot of growth in these pockets that surprise people, but it makes sense from the basic economics of it.
Sure. Now, are you guys, I know you're still kind of early in your, from your company's life cycle, so are you guys spearheading each of these, or are people actually bringing opportunities to you that need to be funded?
Sure. So we started out with us being the real estate developer and building the technology and working through the securities issues. Mainly also in 2010, the idea of having a real estate owner crowdfund capital was very out there.
Right.
The idea of letting small investors into multi-million-dollar assets was very unlikely to happen. So we started with our own transactions. And after we did a few of our own deals, we did the first crowdfunded deal in the U.S. where any investor from D.C., any resident of D.C. or Virginia could invest in a single building we were developing for as little as $100.
Wow.
So kind of true accessibility for everybody. Then there was enough interest from other real estate companies that we realized we can't scale with us buying and developing the assets. It's too difficult. But we can scale as providing financing to the real estate companies. So now what we do is we have a stable of developers that we, some come online, some are offline. We underwrite their companies, they start showing us deals. We then fund the deal with our own cash as a company and then put the deal up on Fundrise to let investors buy into it. So it really is us curating and finding real estate companies and neighborhoods and deals that make sense to us and then making those available to individual investors.
And I imagine, just as a kind of general rule of thumb, and I'll just use an individual single-family house, which is primarily what I invest in. So the less work the house needs, generally the more risky it is. So if it just needs paint and carpet, it's not that risky. But if it's a burnout, it needs everything, then it's obviously more risky. So that kind of ratio of repairs needed to kind of the value of the property when you at least first purchase it is kind of a good indication of risk. And from what it sounds like, the type of projects you're working on, I imagine the repair to get it to the state that you ultimately want to get it into is the vast majority of the expense of the project, right?
Yeah, so we really focus on, rehab, renovation, development, value add. We're coming in, closing with bank financing, they're renovating, changing the asset, and then once it stabilizes, they take us out in the deal. So we won't, we make sure that it's top quality sponsorship, people with existing track records with capability,
right.
Make sure the assets are in very good locations, but we're willing to fund risk on the construction and development side.
Yeah.
I think one, because that's our background, that's what we're comfortable with, and two, because the real demand for crowdfunding is when you can get to double-digit yields, and the only way you're getting double-digit on high-quality real estate is if the asset's in transition.
Yeah.
So it's been a mix. So generally, the position we're funding, let's say it's a $10 million deal, they'll have a bank loan for 60% of the project cost, $6 million. That'll be at 4%, 5%. Then we go from Fundrise goes from 60 to 80% in the capital stack.
Okay.
As preferred equity, so second in repayment after the bank, at normally between 10 to 16% annual return, and then the last 20% is equity from the sponsor. So we're in during the construction phase, during rehab, during development. Once it stabilizes, they refinance based on the new income stream or sell if it's condos, and we get taken out. So we really are in that period where they're heavily rehabbing, adjusting, re-tenanting, upgrading,
right.
And that's what we enjoy. We like that part of the transaction.
Yeah, if you're comfortable with it, it's always a risk versus reward trade-off, right? And if you're comfortable with, a lot of people think even the stuff that I do with rehabbing houses, just kind of the easiest form of real estate investing, or people probably hear that and say, no, maybe it's notes or something else. But any of us that are professionals that have done what we do for a long time, a lot of outsiders see that as risky, and you're like, I see anything other than this risky because it's what I know, right?
Right, it's what and that's what we found, that it's a market that our family's been in for a very long time, that we were doing ourselves. within these core urban areas, within these neighborhoods, with these dynamics that we were saying, they're too unknown for institutional scale. They're a little too small, but they're right in the wave of growth. The home prices are already boosted in those areas. They make sense for us to fit, and I think particularly the technology aspect of our business, the internet very well functions with small, medium enterprise.
Yeah.
And that's the market that we're funding, the mid-sized real estate sponsor, doing 3 to 5 deals a year, a couple partners. They have the cash to put $1 or $2 million in, but it's easier for them to raise than the rest from us as opposed to going to their friends and family.
Right.
So I think technology should even a playing field on financing. And right now, if you're a large institution, it's very easy to raise capital. I think the mid-size of the market will have greater access to capital, particularly through crowdfunding.
Yeah, and one of the things that's really fascinating, and I know you, because I studied your website a little bit, and you guys kind of hit on this in some of the videos that you have, but it's really an interesting phenomenon that people that are not real estate investors per se, they just have some money to invest. And I just heard you mention that somebody with as little as $100, at least in this other project that you had, could invest. It's really the first time that people can kind of, not anonymously, but invest in small chunks of something that's actually in their market that they can drive past and just say, I'm a part of that. That's a really cool thing without actually taking on all the risk of doing an entire project. Maybe just talk about that, the appeal of people that are potential investors in crowdfunding type platforms that can actually see a local project and know that they're impacting their community.
That's really where we started from, and we were building urban infill development projects in DC. We had a famous local chef that we had leased the building to. It was a beautiful historic renovation. Community meetings, everybody knew about the project, and it was strange to us that they can't invest in the deal. They're the ones that benefit from it being rebuilt.
Yeah.
They live nearby. They intuitively understand the market because they bought a home. They have some gut instinct about it. Why can't they invest in real estate? That's where we began. And eventually, after a lot of lawyers, a lot of securities law, the way the rules are written now is if you have $1 million net worth or above, or 200,000 of income or above, you're bucketed as accredited, meaning you're very likely regulated. It's very easy to sell investments to those individuals. But the second that you want to offer to anybody below that threshold, which is 97% of the country, which is pretty much everybody,
Right.
You run into enormously difficult rules around filing documents, around reviews of materials, that for the first deal it cost us almost $1 million of legal to raise $325,000 in $100 increments.
Wow.
So we had to really just run the gauntlet to figure out how to make it possible. But that was very unnatural to us. If you think about people's portfolios, people buy Google and Apple stock because they use the products, they know that business, maybe not the margins and the balance sheet, but they feel comfortable because they use the product.
Right.
Real estate's a similar asset. It should be something that individuals inherently have interest in investing. So our thought was, over time, that you basically have a majority of the market who hasn't been able to access this type of investment. Intuitively, people connect with it.
Yeah.
There's that sense, I live nearby, I drive by it, I know it. We're doing a project in Detroit, the redevelopment of the old Tiger Stadium. Everyone in Detroit's been to a baseball game there.
Right.
Why aren't those the people that are investing in part of redeveloping that project? So for us, it goes beyond being a platform that's just for institutional or high net worth investors that are already in real estate. It's trying to expand real estate to a new market, in addition, who historically has been blocked out. And ultimately, you start to change who the investors are and who's writing the checks. You can change what gets built. And I think the type of historic renovation, tenants that are more connected to the local area, better greenscape, better walkability, those aspects that are in demand, that are often hard to finance into the deal, will be something that maybe people actually want to invest and support. So it changes the dynamic also on the capital side when you change who investors are.
Yeah, that's fascinating. I think people generally want to participate in stuff that's in their community. I mean, I know there's things that I do inside of my little community that I'll pay more for things there, or I'll frequent them more often, just because I know it's the owners there live in my community, and it's just this kind of ecosystem that a lot of people are willing to support. I think that's a really cool.
It's even sometimes when we talk about this aspect of our business, people say, well, it's you're giving away money. It's not for, these aren't the best investments. But it's the other way around. There's been tons of data that have shown that local businesses support the economy in terms of dollars staying in the region better than national chains.
Sure, yeah.
These are actually more impactful, better. They're able to better serve demand because they understand exactly that market. So I think it's the other way around. They're not as well understood by institutions. So they throw a risk number on them because they don't get it. But the assets themselves, it's not people giving away money. These are the projects that often make the most sense.
Right. These
are real investments. You're just making it accessible to everybody, and you're focusing on projects that are serving that community, but that's where the demand is. If they're serving that neighborhood, then that means that it's serving their specific market. So I do think, we hope to not just finance traditional real estate deals, but also projects, and that's why we like the development construction aspect, that deliver an improvement that actually change the dynamics of that area that they're building in.
Sure. Maybe you could take a couple minutes to just talk about how the regulations are kind of shaping up, because I know it's like a constantly moving target, and some of it is not necessarily that the regulations are changing, it's just that they've been clarified somehow, or some precedent's been set, right?
Sure. So we founded Fundrise in 2010. At that point, the Jobs Act had not been passed. So the Jobs Act was a new rule passed to simplify capital raising rules. So we started in 2010. At that point, really, the only ways to raise funding were through Regulation D, which limits your availability to accredited, the high net worth investors I mentioned, or Regulation A, which is what we pioneered. We were the only platform and company to really use it for real estate. Took us, 18 months of filings, almost $1 million of legal. Not an economic path, but it was the only mechanism to sell to individual retail investors. So that was the only choices at that point. And as you can imagine, most people picked high net worth. Most investments were limited to high net worth. You couldn't publicly market them online. Then the Jobs Act passed in 2012. The main goal of the Jobs Act was to ease every rule around capital raising, not just related to crowdfunding. And so, of course, the SEC initially focused on the rules that dealt with the higher net worth investors because that's easier to deal with, easier to police, less political risk.
Right.
So the first rule that went into place took Regulation D, which is limited to accredited investors, and allowed you to market a deal publicly in addition. So previously it had to stay within friends and family, your existing network of people you have a pre-existing relationship.
Right.
That rule went into place September of 2013. Now you could take a deal, market it online. It would limit that you could only sell to high net worth investors, but expanded your ability to market it. So that was a big change, not in terms of who could now invest, but in terms of marketability. The second big change that is just put in place, that will be in place in June, expanded Regulation A, which is what we use to be able to sell to individual investors, that took 18 months and cost a lot of money. Yeah. Expanded that rule to allow you, as opposed to having to file with each state, we had to file with the SEC and District of Columbia and Virginia. As opposed to have to filing in every state where you want to sell investments, you can now file once with the SEC, raise up to $50 million a year through this rule, and just have audited reporting. So that one, you still have a slow filing process that might take 6 months or so, but it eases and expands your ability to raise from individual investors to anywhere in the country to a larger amount and simpler reporting because it's just with the SEC. So that was kind of the biggest next shift. And then the third major shift, which is the most drastic shift, but still is not put in place, is regulation crowdfunding. So it's a specific rule called regulation crowdfunding that will allow you to take an offering, file it with the SEC. 21 days later, you'll be able to sell to any investor in the whole United States.
Wow.
No net worth minimums. There'll be some caps on how much they can invest. So that rule, as you can imagine, it makes the SEC the most nervous, has the biggest profound shift. It's not adjusting an existing rule, it's implementing an entirely new rule.
Right.
I wouldn't expect that to be in place before the election. Unfortunately, it's probably another 2 years away, maybe longer. Yeah. But when that's in place, the speed upon which deals will happen for retail investors, and every individual person will now have the ability to invest in private business, whether that's real estate, small business, solar energy, whatever it would be.
Yeah.
Will greatly expand investors' access to investments and will fundamentally shift capital raising. So that one is the real revolution, but the SEC is taking their time.
And it'll give people the ability to invest their own money as they see fit.
That's the plan. I mean, it's been overregulated and overpoliced, and regardless of which side of, politically or the way the rules have been written is, if you're wealthy, we don't need to worry about it. You can deal with yourself, and if you're not wealthy, we're going to regulate it so aggressively that now nobody sells to retail investors.
Right.
So by over-policing it and making the regulatory burden so high, it's just a fact. Nobody goes through that route. And so thus the only thing that individual investors can buy are stocks and bond funds,
right,
which is very limited, which is a small subset of what people
Absolutely.
So our thought is, if you take
almost none of which is in your community.
None of which is in your community, none of which you can really touch. They're all big organizations. They're huge. You're not connected to them. And so we think, one, the regulatory shift is going to bring a whole new type of investment that's, more about branding and marketing and connecting with people who are your investor base.
Sure.
Local coffee shop, whatever it would be. And second, I think people's portfolios are going to drastically shift from, 60% bonds, 40% equity, whatever the traditional mix is, to maybe 8% commercial real estate and 5% local business and 3% alternative energy, whatever it would be. And so it's going to bring a huge amount of capital to new sectors, and I think in particular those sectors that are more consumer oriented or focused on millennials or digital consumers will have a whole new marketplace to raise capital. I think it's really a fundamental shift.
Yeah, absolutely. Awesome. Well, I know we're a little bit tight on time today, so why don't you tell us how people can learn more about Fundrise and your company. Where should they go?
Sure, they just go to fundrise.com. They can create an account for free. They'll see new deals as they're available. They can reach out to our support and ask any questions. But we try to be very transparent. The whole point is bringing access to commercial real estate where people previously didn't have the ability to invest. So we've tried to make the site, we have an education section, very user-friendly. And they can also find me on Twitter, Dan__Miller, and message me. We always try to be available.
Awesome. Well, thanks so much. It's really a fascinating space, and I know a lot of people are keeping an eye. If they're not involved with it right now, they're keeping an eye on it to see where things go, because it's obviously it's a hot topic and a hot area right now.
Yep. Thanks for the time. I really enjoyed it.
Yeah, Dan. Thanks so much for joining us today. So we'll add a link for fundrise.com down below, but it's fundrise.com, easy enough. So, Dan, again, thanks so much for your time today. Appreciate you sharing your story and some information with us.
Thank you.
All right. Have a great day. Are you a member of flipnerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit flipnerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to flipnerd.com.